It's tax time.
Hello, and welcome to the My Father Said podcast, where we discuss all things faith, finance, and family. I'm one of your hosts, Ryan. I'm both a father and a son.
Hey everyone, I'm Robert. I'm Ryan's dad. I'm a father myself, and today we are excited to bring back with us everybody's favorite tax guru, Frank.Thomas with Thomas, Watson and Company. He is the man who can show you how to evade taxes and not go to jail at the same time. Is that a good introduction, Frank?
I wouldn't put it quite that way.
If you could change one word, what would it be?
I would change evade to minimize.
There you go. Well, we'll think about that. Anyway, anyway, yeah, it's coming toward the end of year 2024, and it's amazing how it seems like we just had this same podcast maybe 3 months ago is what
Yeah.
it feels like.
Except you weren't here. That was just me and Tim.
Yeah, it's phenomena. It seems I've heard this, and I'm finding it to be true, that the older you get, the faster time passes by.
So are you saying you're old?
I am saying I'm old because literally it seems like this was only, like I said, a handful of months ago, and we did this for year end in 23. So we're going to get Frank in here today, and he's going to discuss some tax reduction strategies, not tax evasion, because we don't want to be any party to your going to prison and claiming that you're following something that we said, because we did not. But anyway, we are going to be discussing today the tax reduction strategies for year-end 24. If there's probably something out there that we can get in front of for 2025 and whatever else Frank thinks is beneficial for us. So before we do anything, Frank, any words of wisdom you want to share with us before we start diving into our questions?
Well, this is a general discussion, and with tax law, there are always exceptions. And then there's exceptions to the exceptions. So be aware these are general discussions, and your specific situation may differ. So you need to have that discussion with your tax advisor about the strategies you're hearing about today.
That sounds strangely close to a disclaimer.
He's been around the block a few times.
That's what that sounds like.
But before we get
you said.
yeah. But before we get into all of the nitty gritty stuff, what you been up to, man? How's the bluegrass? You been playing?
Not a whole lot lately. My daughter has moved to Tennessee, so I'm still hearing a lot of it, but not playing so much anymore.
Sure. I gotcha. And how many grandbabies you up to now?
2.
2 grandbabies. All right. Good stuff. We
But
got a third coming anytime soon, or?
Oh, I think we just got 2 for now.
Oh, okay.
But now Ella is graduating, right?
Graduate Saturday.
And
wow.
after she graduates, what is her plans?
She's going to be a musician in Tennessee.
In Tennessee.
Good for her.
Tennessee.
She's still playing with, what's the name of the lady?
Caroline Owens and New Company.
Yeah, Caroline Owens and New Company. So she's still sticking with that group, or is she going to broaden out?
She plays with some other ones too.
Yeah.
That's awesome.
Yeah, I remember that day years ago. I said to you that she's not going to be a school teacher. She's going to be a musician. And you looked at me like, I don't know. And here we are today talking, and she is a musician, and she's not a school teacher anywhere.
Yeah.
Yeah, that's good stuff. She owes me Opry tickets, by the way.
Yep. You should cash in.
Yeah, she owes me Opry tickets. I mean, front row, backstage tours, all that kind of stuff.
Yeah, she played at the Station Inn in Nashville last Wednesday night, and you should have come.
Yeah, I guess I should have come.
What were you doing?
I think I was at church, I think, but it is what it is. Well, anyway, let's get on with this, because I know our listeners are overly excited to hear about taxes. I mean, when I get up in the morning and I think about taxes, I mean, my mouth waters, I get excited, I get zoned in, and I'm lying through my teeth.
Yeah.
Because taxes do not excite me, because I hate paying taxes. I hate having to give my money to to a government that I think is wasteful, irresponsible, and we're not going to go down that track anymore. Just
right.
just because I'm not even going to go there, because I get angry and upset, and we'll lose the whole meaning of this.
Well, our problem is spending, not revenue, because we've had the biggest revenue year ever. But the problem is we're just spending too much, and hopefully we'll get that lowered in this
I
next.
think, who is it? It's
4
Musk
years.
and
DOGE, the Department of Government Efficiency.
Ramaswamy,
Ramaswamy.
Can't pronounce it.
Ramaswamy, Vivek, in the Doge. It's called Doge, I think. Yeah, we'll see what happens there. I'm just excited to see how many people get belligerently angry. Is what I'm getting ready to sit back and watch and see how that works. And hopefully I'm not one. All right. Hopefully they won't decide that we are a wasteful part of spending. But anyway, so Frank, we're nearing the end of 24. We're in December right now. So from a W-2 wage earner, I want to begin there. We're going to go W-2s and then we're going to do 1099s. From a W-2 wage earner, W-2 household, are there any strategies that a person can get implemented before year end to perhaps avoid some taxes, minimize some taxes that they're going to end up paying if they do not use these techniques?
Okay. With W-2 employees, there aren't quite as many opportunities as there are for those who are self-employed. But some examples are: make sure that you've maximized your 401k, particularly if your employer is providing some sort of match, because that's free money. And you want to make sure you've paid your property taxes and on your car and on your house, and make an extra mortgage payment to get the January payment, the interest deductible in December.
Oh, yeah.
There's a student loan interest. Make sure you get all your charitable contributions in. And you know, if you have a big income year, there's something that's available where you can have like a donor-advised fund where you make a big charitable contribution. Like, for example, you contribute $100,000 to this donor-advised fund. I think Central Carolina Community Foundation does these. And then you can have them give out the money over a period of years. So you might want to give it out at $20,000 a year, but you need the deduction this year, not years 2, 3, 4, and 5. So you can kind of front load your charitable deductions if you have a big income year.
So talking about that, let's say I'm going to make an assumption here. I would assume that, you know, here in the South, being in the Bible Belt, a lot of people's charitable deductions are going to churches and stuff. If you had a donor-advised fund, could you say, I'm going to give $100,000 to it, take the deduction now, and then get them to donate the money to the church year over year? Oh,
can.
okay, cool.
Another thing, particularly in the realm of investments, is if you have big capital gains, you had a very successful year, maybe you sold some NVIDIA, that you look at what's in your portfolio that might have losses in it and sell those securities in order to generate losses to offset your capital gains. So it's basically you're harvesting some tax losses in order to lower that.
And both of these options are available to W-2 employees?
Yeah.
Yeah, okay, cool.
Wow. So what is you mentioned income, what's the maximum income, if I'm asking the question right, Frank, what is the maximum income a person cannot exceed to be eligible to make these deductions to this donor fund that you're talking about?
No, it doesn't matter what your income is.
No income at all.
Oh, that's awesome.
Yeah.
Other things that you can do is make an IRA contribution. That's kind of, everybody knows about IRAs, but you don't want to forget about them. And you can do it for your spouse, even if they're not working, as long as you have enough earned income. Another one that you don't think about very much is an HSA, a health savings account. Now, you only qualify to contribute to a health savings account unless you have a high deductible plan. But if you have one of those, you can contribute like $8,300 or so into an HSA and then use it to pay medical expenses. And if you don't have that much in medical expenses, then you get to roll it forward to the next year and you put in another $8,000, then another $8,000. It's almost like another investment account because you can actually invest that money as well. So it's like an extra investment account, but it's like a reserve to pay medical expenses when they occur. But you only qualify for the HSA deduction if you have a high deductible plan.
Speaking of the HSA, tell me if I'm making this up. Is there a certain age where someone who has an HSA, they can pull the money out penalty-free, even if it's not used for medical purposes?
I don't think so.
Okay. Is there some sort of age, something with the taxes with HSA, like if you get into your 70s?
You can't contribute to an HSA once you start receiving Medicare.
Oh man, that's awful. That's
Yeah. So
nowhere in the right direction I was going.
At 65, if you're on Medicare, you no longer can contribute to an HSA because you don't qualify because don't have a high deductible plan.
Sure.
You're on Medicaid.
Sure.
But on that being said, I had someone call me this year, and he was going to go Medicaid in December, and he goes, "Can I still contribute to an HSA this year?" I said, "Yeah, as long as you do it before December 1, you can do that."
Is this Medicaid or Medicare?
Medicare, excuse me.
Okay. All right,
Medicare.
yeah. I want to make sure I've gotten that right. Okay. So for our listeners, that was a slip of the tongue. It's not Medicaid, it's Medicare.
It's Medicare.
Meta something.
Yeah, I was trying to.
Something.
Yeah, if it has meta in front of it, call Frank. All right, make sure and be clear what's going
I
on.
don't even
there.
realize that I said Medicaid. So Medicare. Medicare.
You know, for years I couldn't tell the difference between Medicaid and Medicare until I got in this industry and started digging around, and more importantly, got older and started working with older clients. And then you're kind of forced to learn that stuff. And yeah, you think the governmental tax code is a challenge. You ought to work with
Look
the
at
Medicaid
Medicare.
people.
Yeah, Medicare, Medicaid.
Yeah, I remember when Mom went on Medicaid. That was a chore. That was a chore.
So since we're talking about that, we got a couple of years before you and Mom hop on Medicare, but have y'all talked about, which one you're going to do, A, B, C, an Advantage plan, something like that?
We have been talking. I've been talking to various professionals in that who do that, who recommend that. And I've also been talking to our clients who are on Medicare or Medicare Advantage plan. And I've been picking their brains to see why they chose the one that they chose. And to get to the ultimate answer that you're seeking, right now, if I had to choose today, I don't know.
That's good.
I mean, it's just, I don't know just because of the various options. It has a lot to do with where you live, where your zip code is.
Oh, no kidding. In your world, Frank, is there any tax benefit of one Medicare plan over another?
I don't really think there's a tax benefit. I mean, it's the income issue. I was just talking about this with my business partner yesterday, and somebody who's very close to her actually works for Blue Cross and Blue Shield and it sells this, and he said that the Advantage plan is the best, but I'm not exactly sure why. So, I mean, it's not a tax issue. I'm not the person to ask.
Good deal.
That's fair.
Good deal. So we went through the W-2 items, and essentially, I think I'm going to put some words in your mouth, and you tell me if I'm on target or if I'm offline. W-2 compared to 1099 for availability or opportunity to take advantage of or to utilize better the tax code. Let's not say take advantage, but to utilize better the tax code. The tax code provides more opportunity for 1099 individuals to get deductions than it does W-2. Would that be correct?
That's true. Years ago, you could actually deduct what was called miscellaneous itemized deductions. That went away in 2017, or into 2017. So back then, if you were like an outside salesperson, you might get a W-2, but if you weren't reimbursed for your expenses, then you could deduct them on a Form 2106, which rolled over to miscellaneous itemized deductions. So you could write off business mileage. I had a client who was an outside salesperson in a certain industry, and he would have about $30,000 of miscellaneous itemized deductions in a given year. In 1 year, he was audited because that was a lot, and IRS came in and he could provide documentation, and there was no change. Awesome. But what happened when the law changed is the government's looking at it saying, well, if these are really business expenses, your employer should really be reimbursing you for these amounts. So what they did was basically said, they can reimburse you the business expenses, and it's not taxable income to you, rather than giving you the gross amount and then you deducting the expense. But what they were trying to do wasn't to harm people who were outside salespeople. It was trying to rein in people who were claiming deductions that they really weren't entitled to. But if you're a self-employed person and you get paid by 1099, you can basically write off any business expense. If there's a business motivation to the expense, you can write it off, with the exception of entertainment. They did away with the entertainment deduction in the same year, 2017. But you can write off business meals, you can write off business mileage, you can write off advertising, you can write off your cell phone, you can write off office supplies, you name it. As long as it has a business purpose, you can write it off. And that's the advantage to being treated as a 1099 contractor or a self-employed person versus being an employee. Employees have to be reimbursed by the employer, but the independent contractors, they can pay their expenses and they don't have to worry about being reimbursed. Now, where all that sounds so wonderful and good, the downside to being a self-employed person is that you have to pay both halves of Social Security. So you're paying less in income tax, but you're paying more Social Security and Medicare tax. So what do I mean by both halves? When you're an employee, your employer withholds roughly 7.65% of your paycheck in order to pay in on your behalf to Medicare, I said it again, Medicare and Social Security. And then the employer matches that. So for every dollar of earnings, you're getting, or Social Security and Medicare is getting paid 15.3 cents. But half of it's coming from the employee and half of it's coming from the employer. But when you work for yourself, you're both the employee and the employer, so you have to pay both halves of it. So where it saves you a lot in income tax, you kind of get bit a little bit with the self-employment tax, and sometimes that's a surprise to some of my clients. I had someone I was supposed to meet with earlier today who canceled and wants to reschedule, but that's their issue. They hardly owe any income tax at all, but they owe more self-employment tax than they were beginning to imagine.
So they hardly owe any income tax.
That's right.
But they owe some self-employment tax. Those two combinations, is that a bad thing?
Well, it's nice to pay less in income tax, but paying more in self-employment tax, I mean, nobody likes to pay tax. The plus side of paying more of self-employment tax is theoretically you get more credit for having paid in for Social Security, so when you retire, you get more out of it. But if you're in your late 20s or early 30s and the retirement age now is 67, and it probably will end up going to 70, and you're looking at 40 years down the road, and is it going to be there in its current form when I go to retire? That's a good question. And if they're not sure how it's going to end up, of whether they're going to get a benefit for it, they're nervous about it. So I have that discussion with my clients, and I tell them if you do anything to minimize your Social Security tax, then you're going to get less benefit. So you need to take the savings and invest it with Cornerstone Financial Group, so that they'll have the retirement money available for them. And then they can manage it, and they don't have to depend on the government whether they can receive it or not when they retire.
And then, correct me if I'm wrong here, there's also with like how if you're self-employed 1099 and you've got like an LLC, there's a strategy of classifying that LLC as like an S corp, right?
That's right. So an LLC is a legal entity, not a tax entity. An LLC can be taxed in any number of ways. It can be taxed as a sole proprietorship. It can simply own rental property, and it's ignored for tax purposes, just like if you own the rental property individually. It can be taxed as a partnership. It can be taxed as a C corporation, or it can be taxed as an S corporation. So why would you want it to be taxed as an S corporation? Because then you can limit the amount that you're paying in to Social Security. The law requires that if you have an S corporation that you pay yourself a reasonable salary. So what is a reasonable salary? Well, that's up for each individual taxpayer to decide, because you could be working 100 hours a week, or you could be working 3 hours a week. I mean, so if you're working 3 hours a week, obviously your salary is not the same as if you're working 100.
Sure.
So based on your efforts, I mean, my recommendation for that are typically you got to pay yourself at least as much as you're paying, an employee. You got to make at least as much as them. But in other words,
Note to self, cut salaries.
Well, there's a saying: pigs get fat and hogs get slaughtered. So be reasonable about it. I had a client years ago. They were actually a doctor. They had an LLC, and they elected to be taxed as an S corporation. And they came in the next year and had not paid themselves any salary at all. So it's all S corporation income. I said, you can't do this. You need to pay yourself a reasonable salary. Okay, next year they come back, hadn't paid themselves any salary. So they had paid on S corporation earnings, but no self-employment tax. After about the fourth year, the IRS audited them. But if you pay yourself something, at least you have a leg to stand on, and you can explain in some reasonable way how you arrived at that amount.
Why have you paid yourself $0 for 4 years? Well, I fired myself because I was a lousy employee.
Well, the guy was a doctor. So, I mean, it's really, from his services, what else is he getting paid for?
Sure. Yeah.
That's interesting. So, Frank, I'm going to turn the question around a little bit, because, again, there's so much stuff out there that is this deductible, is it not? And it can become confusing, because I've seen that book of tax law, and it's a pretty large, intimidating book, which is now online, obviously. But for a person such as myself who does not live in your world, just the mere conversation of taxes is intimidating beyond imagination. So my question that I would ask you for our listeners, probably kind of like in a rapid fire session, would be, just off the top of your head, self-employed or 1099, or W-2, it doesn't matter. What is obviously not a deduction? Not what is a deduction, but what is not a deduction that a person ought not even try to consider coming to you and claiming, hey, I did this and I want to deduct this. What's not a deduction?
Well, any type of personal expense. If you buy groceries to feed your family, that is obviously not a deduction. But like one that I get a lot of calls about are like gifts to family members. Oh. So a parent decides, I want to give my child $18,000. And the reason I'm using $18,000 is that's the amount for 2024 it qualifies as the gift tax exclusion. For 2025 it'll be 19. But anyway, they've given them $18,000. Well, it's a gift tax exclusion, not an income tax exclusion. So they don't get a tax deduction for making the $18,000 gift, and the child doesn't have to pick it up as $18,000 income. It's just a gift.
Right.
Gifts aren't taxable. But in the estate tax world, where the gift tax and estate tax work together, when you file an estate tax return, if anyone ever hits the exemption amount, which is like $13 million now per person, then you bring back in all the prior gifts. So you track the gifts over your lifetime, and then when you file an estate tax return, you're basically laying out all of your lifetime transfers, and then you pay estate tax on the net anyway.
So since we're in December, if I can interject, What I just heard you say is my wife's Christmas budget is not a deduction.
It is not a deduction unless she's buying it for your clients.
Well, I feel like everybody in my family is my client.
Well, you can deduct up to $25 a person on a gift, business gift.
How do I prove it's a business gift?
I guess you would have to come up with a list and show that you have made money off of them, a client list, basically.
Oh, my gosh. When it comes to my family, I am upside down. Yeah, I will
So
never.
you got income from your family,
Yeah.
not expenses.
Yeah, I will. I will never ever be in the black on that side of the game.
Yeah.
Almighty.
So they give you more money than you give them?
Man, yeah. I will tell a story one time. Whenever I met Frank, I was out looking for my own a new CPA because the CPA I had for years had retired, and
I hear that a lot now.
Yeah,
got one of those calls today.
Yeah, good. My CPA, great guy, love him to death. He's retired. He's moved away from here, and from what I understand, he's enjoying life, which is well deserved on his part. And I remember I had met Frank here, and I had taken my tax return to Frank and said, "Hey, Frank, I'm looking for a CPA. You bringing on new clients?" And Frank looked at me. He said, "Well, you don't look dangerous, so I think I'll take you on." And after I gave him, my resume, and I answered his 9,000 questions about, these kind of things, and promised that I wouldn't take him to court, in a frivolous suit that I have tried to get past anybody. The usual things that a CPA tries to make sure that you're not doing. Frank said, "Well, let me get your returns from the last 3 years," which I thought was odd. All right, I thought, well, that's interesting. Why does he want to see my returns? I was thinking maybe he just wants to see what kind of client I might be. Mm-hmm. So I handed him my returns, and I remember Frank gave me a phone call, and Frank said to me, he said, "Hey, what you doing Thursday night before you going out to see your guys to practice?" I said, "Well, I don't know." He said, "Let's go have lunch, or let's go have dinner or something like that." And I thought, this is interesting. At the Pig.
At the Pig.
So we're sitting in the Pig, and Frank brings out my tax return.
Unless you're from Nice's, you won't understand.
Yeah, exactly. Yeah, you got.
It used to be the Giant Food World, if you're familiar with that.
Yeah, now it's the Pig. So we're sitting at the Pig, and Frank brings out my tax returns. They're in the middle of Nice's, and I thought, great, this is going to be all over the countryside now. And so Frank says to me, he says, "I can get you back," and it was a 5-digit number in my tax returns, and I said. I gave him that look like, "What?" And he said, "Yeah." He said, "Because this box right here on your tax return was not checked." And that was it. It was just a box that was not checked, that because of the industry I'm in, I was qualified to have that box checked. Have I got that right? The industry I'm in?
Active trader business.
Yeah, active trader business, yeah. So he checked that box, and the only thing that I really was annoyed about is it could only go back, 3 years?
Yes, you missed all those other years.
I missed all those other years, and I'm just thinking, my gosh, what did I overpay that I wasn't required to
The state
pay?
of South Carolina appreciates it.
I bet the state of South Carolina does. So I say that to point out to you guys is that whenever you're working, we say it a lot in our industry that if you want to accumulate wealth in your industry, in what you're doing in your life, we say it all the time. You're going to love us, all right, just because we're working with you to help you gain and to stay focused on that. But every person who's trying to pursue wealth accumulation has got to maintain a relationship with a CPA. You got to, because the CPA is going to be your best friend, especially if the CPA and you have an understanding of what you're trying to accomplish. Now, I'm not talking about tax evasion. If you've got a CPA who's willing to carry that conversation on with you, you need to fire that CPA and get one who is honest, because if you're sitting in court one day because you signed that document, you're going to prison, all right? The CPA may or may not. Because the CPA, if they're unscrupulous enough to talk about evading taxes, they're unscrupulous enough to say, well, I'm only using the numbers they provided. So you want to watch out for that. But a CPA will give you all types of insight on on how to take advantage of the opportunities that the tax code legally presents. And that's why, I refer everybody I work with, I refer them to Frank and just say, hey, go see this guy, all right? You might have to listen to him talk about bluegrass. You might have to listen to him talk about his children, and that's all fine. Mm-hmm. That's all fine, but I'm telling you from personal experience, the man got me a 5-digit return on overpaid taxes.
And I didn't even change your income.
Yeah, it didn't even change my income. He just went and checked the box. I mean, it was literally that simple.
What'd you spend it on?
Your mama.
The Christmas budget.
Once she got wind of it, she had a list.
That's good.
But yeah, so Frank, really with the tax code and all, what would you say in your estimation, Frank, the percentage of people that when you first meet them as brand new potential clients, what would you say is the percentage of people that are really, and I'm going to phrase this question a certain way, that are paying more in taxes that they are not obligated to pay, and it's really a simple fix? What percentage of people would you say?
I'd probably say about a third of people.
33%.
Yeah.
Wow, that's a lot. That's a lot. So a third of the people who come to see you are paying more taxes
And
than...
it may be higher than that. I just don't want to be too aggressive.
I got you.
Probably about a half, but I'd stick with a third for discussion purposes.
So really, if you stop and think about that out there in podcast land, a third to a half of you are possibly paying more in taxes than you're obligated to, and it's a simple fix. Think about that, a simple fix. How many hundreds or thousands of dollars each year could you be putting back in your pocket with a proper relationship? And again, that's why we say, Scripture tells us that with counsel we succeed in our plans, with wise counsel. And when it comes to wealth and managing money, you want to surround yourself with wise counsel. And again, I've said it earlier and I'll say it again. I tell every client, they're going to love us. Mm-hmm. If we do our jobs, they're going to love us. But your absolute best friend, first and foremost, is your CPA. Mm-hmm. And you've got to have that person in your life. If you don't have that person in your life, you're playing roulette with your financial future. I mean, it's not so much the money you got back for me that I look at now, because my income is significantly higher today than it was back 10 years ago. Had I not hooked up with you and you found that box that wasn't being checked, how much money would I have been at this point in time overpaying that was absolutely not necessary? And one thing that I realized in your and my relationship is there's nobody up there at the government, at the IRS office, that goes, "Oh, look, Robert didn't check that box." And he is eligible to check that box, and he didn't. So let's check it for him, and let's, out of the goodness of our heart, let's send him his overpaid taxes back to him.
They don't do that?
If you make a mistake on your return, they don't necessarily fix it for you. Sometimes they will, but sometimes they don't. It just depends on the situation.
Oh, well, they ain't never fixed mine.
Yeah.
Well, with that one, it was an election to calculate your tax using the active trader business form, which was I-335, and you didn't have that box checked, so you didn't use that form to calculate the lower rate. So they're not going to fix that if you don't make that election by checking the box.
Oh, well, you know what?
And that's why we got Frank.
They need to step up and do their job a little better.
Something that you said about the accountant or CPA being their best friend. Last year, 300,000 more accountants retired than came into the workforce. Last year, 300,000 more CPAs retired or accountants retired than came into the workforce. That's huge. So we're getting fewer and fewer and fewer and fewer. And why is that? Because there were some changes in the law maybe 10 or 12, even 15 years ago that kind of made becoming a CPA somewhat prohibitive, requiring a master's degree and some other things. But there's things in the works that hopefully will reverse some of that. But if you've got an accountant that you're happy with, you better keep them, because it might be a little difficult to find another one.
Wow. So now are y'all taking on new clients now with all that information?
But we're having to be a little bit more selective, because, we only have so much capacity. So
Yeah.
Oh yeah, we're still taking on people, and we're actively looking to hire more people. They're just hard to find.
So did you hear that? At Thomas and Watson and Company, they are actively looking to hire top-notch quality accounting type people focused on taxes.
Please send us your resume.
Please send your resume to
attention.
them, to Frank Thomas's attention. Let them do an interview with you. They have a 401k package for their staff. They have a nice building that's right across the street from a Mexican restaurant.
Mm-hmm.
That's a winner all by itself. And right around the corner, I think, is a Cracker Barrel, I think. So
About 4 minutes from here.
Yeah, about 4 minutes. So it's a great place to go to work, and we're trying our best, because we don't want Frank to quit on us either. Because I'm getting too old. My arrangement is that my accountant stays in the accounting firm until I die.
Yeah.
They can't retire when I retire, and they can't leave before I retire, because that's not part of the agreement. And Frank agrees. It doesn't matter if you're 20 years of age. Frank agrees to stay with you forever. All right. I mean, it's just the way it works. It's just the way it works. So, Frank, anything else for our listeners that we should put out there for them to consider for maybe upcoming in 2025?
Well, I don't think there will be a whole lot different in 2025 than there was for 2024, although they're talking about a new tax package that they're going to come up with. Hopefully they'll renew all the tax cuts that we had beginning in 2018, and hopefully we'll go farther. And because like I mentioned earlier, as far as government revenue, last year was as high as we ever had. So it's not a revenue problem; it's a spending problem. But for everyone out there, maximize your retirement accounts as early as you can. If you're a W-2 employee, participate in your employer plan as far as you can, as much as you can possibly do. If you're self-employed, set up a set plan, solo 401k, simple plan, or do an IRA. But starting young makes a huge difference. If you wait until you're 45 to start saving, you cannot accumulate. You can work very, very hard, but you can't begin to accumulate what you could have if you'd have started at 35 or 25. But so maybe you're past 25. Well, today's the day to start. Maybe you're 26. Maybe you're 36. Mm-hmm. But start as early as possible. Set aside as much as you possibly can, and because that's the way you accumulate and have a comfortable retirement. Mm-hmm. Don't defer. Don't wait. The time is now. Defer as much as you can. And I know a good place where you can set up your retirement plan if you don't have one of those already.
Yes. It's called the Templeton Group here in Columbia, South Carolina. At least I'm assuming that's what he was going to say.
Yes, I was looking at both of you. So.
If not, I was going to preempt him before he said some other company. So, Frank, let me ask this question, and not to get into politics, but just a very simple yes or not so much. Trump winning the presidency, from a tax code or tax income wage earner, is Trump winning a presidency, is, in your opinion, is that better, his plans, is that better for the country going forward, yes, or not so much, or not no big difference, just from what you've read?
I think it's huge because the Trump tax cuts were set to expire at the end of 2025. Mm-hmm. Why is that? Because they have a process called budget reconciliation that they passed this back in 2017, and you can only provide decreases to the budget, and you have to decrease offset so it balance. You have to offset the income or offset the deductions to balance with you have to balance both sides of the equation. I don't remember what I just said. But,
Yeah, for our listeners who are not watching on YouTube, right now Frank is juggling 6 individual balls in the air with his hand as he is putting this statement together.
Right.
If you're not seeing it on YouTube, you are missing a circus act like you've never seen before.
All right, so I'm going to state it again. If there are decreases to income because of decreases in the tax code, there need to be decreases in expenses of the same amount to offset so that it balances.
Okay.
All right, so those Trump tax cuts were supposed to expire, and it was going to be the biggest income tax increase in U.S. history.
Wow.
So because he got reelected, hopefully Congress will be able to keep those rolling forward. There's some other things that they're talking about doing, such as the no tax on Social Security, no tax on tips, 15% corporate tax rate for domestic corporations. If some of that all sounds great, some of it is probably not going to happen. And it's not because he doesn't want it to happen, but it's because of rules of Congress. But I think it was a big win for the everyday American and particularly small business owners for Trump to get elected.
Well, that's good to hear.
Good.
That is good to hear. All right, so Ryan, you got any other questions before we close out?
Only thing I got, which I think we've already done, is if there's any other burning thoughts that you want to share with the listeners. I think we've covered that pretty well.
Yeah, I think so. The discussion about the retirement deduction or retirement deferral of income is huge. Another thing about that we hadn't talked about is Roth IRAs. Some people prefer Roth IRAs to traditional IRAs, and the answer is not correct for it's not the same for every taxpayer. So you need to need to have a discussion with your accountant or CPA or financial advisor. What is your expected tax bracket now? What's your expected tax bracket later? And then make decisions based on what the tax brackets are going to be, and how much income you need to live off of. But planning for Roth IRAs is also another key thing that they should do, because literally we may never see tax rates this low again. We don't know. We know. Well, we think. For as long as Trump is in office, they'll stay the same. We don't know that yet either. We hope that would be the case, but tax changes are only permanent to the next administration. So we don't know who the next administration is going to be, and if your tax rate goes up 10%, you missed an opportunity to roll retirement balances into Roth retirement balances.
Man, that's incredible.
That's good.
All right, so we have had a invigorating discussion about taxes, and I know all of you are salivating at the conversation that's been held, and you're probably going to pull into a Sonic's and get you a medium vanilla ice shake and have fun with that and enjoy it on the way home. So just a couple of important questions, Frank. Without any thought, right off the top of your head, what are you getting your wife for Christmas?
That's a secret.
Yeah. Notice how he was pondering that. It's like, how do I answer this? Well, I'm not going to answer this.
It's going to be delivered to my house, so she's probably going to know what it is before I get home.
Good.
But
That's
I
good.
see.
Yep.
That's pretty good. So it's going to be delivered.
it's been ordered.
It's
It
been
will be
ordered.
delivered.
I see. It's ordered and delivered. So is it too big to fit in the door without assembly, or is it something that you park in the driveway?
It'll go in the door.
It'll go in the door. Well, it's not a car.
It's not a car, yeah.
It's not a car. Forget it. You're going to drive that old beater around another year. All right. So, Frank, last time you were here, I think Ryan or Tim one posed a question to you. What was the most memorable or a memorable piece of advice that your father told you when you were growing up? Now, I'm going to change that question. All right. I'm going to say, what is a piece of advice that you would say you would want to give to your children or any young person around their age based on your life's experience? What's a piece of advice you want to give before we close out?
Well, there's many things that you could say, but the way I look at it is you want to live within your means. Don't overspend. Spend less than you make, because what you want to do is get used to the lower standard of living, save the excess, and you'll never have a financial problem. If you spend more than you make, get into debt, and it starts snowballing, you can ruin your life.
Phew.
That's pretty good stuff. I was
your
expecting something major like vanilla beats chocolate every time.
Nope. Just, living within your means.
Golly.
I like
mean,
vanilla. My wife likes chocolate. So
Yeah. So is she getting chocolate for Christmas? No.
Just getting an ice cream maker, believe
Getting
it or
an
not.
ice cream
It's only
maker.
chocolate.
Or those little churns. Yeah. That's pretty good. Well, Ryan, you got anything before we close out?
Nope. This has been another episode of the My Father Said podcast. As always, if you have tax questions or are you looking for a CPA, Frank's your guy. His information will be in the video. And then if you need help with any of the other stuff that we talked about, setting up that 401k, doing the investments, talking about Roth conversions, we can help you here at the Templeton Group. And with that, we'll see you next time.
The opinions voiced in this video are for general information only and are not specific advice or recommendations for any individual. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.